Have you ever wondered what it takes to become the world's greatest investor? What if I told you the story isn't just about numbers and stock charts, but about a young boy from Omaha, Nebraska, with a paper route and a dream? This is the untold story of Warren Buffett, a journey from a quiet, middle-class childhood to becoming the legendary Oracle of Omaha. It all starts in 1930. The Great Depression was in full swing, and in the heart of America, Warren Edward Buffett was born. His father, Howard Buffett, was a stockbroker and a congressman. And it was from him that young Warren first heard the whispers of Wall Street. But this wasn't just a story of privilege. Warren was a go-getter from day one. At just 6 years old, he bought his first six-pack of Coca-Cola for 25 cents and sold each bottle for a nickel, pocketing a 5-cent profit. It was a small start, but it was the first spark of his entrepreneurial fire. By age 11, he was already buying his first stocks. He bought 3 shares of Citi's Service Preferred for himself and his sister, Doris. The stock initially dropped, and a nervous young Warren sold as soon as it bounced back for a tiny profit. But then he watched in agony as that same stock soared to over $200 a share. This was his first and perhaps most important lesson in investing. Patience is power. It was a painful lesson, but it forged the bedrock of his future philosophy. While other kids were playing baseball, Warren was devouring every book on investing he could find in the Omaha Public Library. One book in particular changed his life forever: The Intelligent Investor by Benjamin Graham. Graham wasn't just an author. He was a professor at Columbia Business School, and he became Warren's idol. Graham's philosophy was simple, yet profound. Don't think of stocks as mere ticker symbols. Think of them as pieces of a business. But buy them for less than their intrinsic value and hold on for the long term. Warren knew he had to learn from the master himself. So, after being rejected by Harvard Business School, a blessing in disguise, he would later say he discovered that Benjamin Graham was teaching at Columbia. He wrote to the admissions office, "I thought you guys were still alive," and was promptly admitted. Studying under Graham wasn't just about learning formulas. It was about adopting a mindset, a discipline, a framework for seeing the world not as a casino, but as a landscape of opportunities. After graduating, Warren wanted to work for Graham's firm for free, but Graham, ever the pragmatist, refused. So Warren returned to Omaha and worked for his father's brokerage. But he never gave up. He kept sending Graham ideas until finally his persistence paid off. Graham hired him. This was his apprenticeship, where he honed his skills in value investing, the art of finding wonderful companies at fair prices. He learned to dig deep into financial statements, to understand a business inside and out, and most importantly, to manage risk with a margin of safety. In 1956, at the age of 26, Warren returned to Omaha for good. He was done working for others. He started the Buffett partnership with a handful of family and friends. Pooling about $100,000 of his own money and from his partners, he operated it from a small study in his home, far from the frantic energy of Wall Street. His goal was simple: to beat the Dow Jones average by 10% every year. He didn't just meet that goal, he shattered it. For over a decade, the partnership achieved an average annual return of nearly 30% without a single losing year. This is where the legend truly begins to take shape. How did he do it? By sticking to his principles. He invested in businesses he could understand, like American Express during its salad oil scandal. When the market panicked, believing the company was doomed, Buffett did his homework. He went to restaurants and saw people still using their credit cards and traveler's checks. He saw the business was sound, bought a huge stake, and made a fortune as the stock recovered. This was classic Buffett: be fearful when others are greedy, and greedy when others are fearful. Then came the turning point: a struggling textile mill in New Bedford, Massachusetts, called Berkshire Hathaway. Initially, Buffett bought its stock simply because it was cheap. He planned to sell it back to the company for a small profit. But when the company's management tried to shortchange him on the price, an annoyed Buffett didn't just sell, he bought control of the entire company. It was an emotional decision, one he'd later call a $200 billion mistake, because the textile business was doomed. But from the ashes of this mistake rose the foundation of his empire. Instead of pouring more money into the failing textile business, he started using Berkshire Hathaway's cash flow to buy other better businesses. He bought insurance companies like National Indemnity, which provided him with a float, the premiums collected that could be invested before claims were paid out. This float became the rocket fuel for Berkshire Hathaway's growth. It was also during this time that he met his lifelong business partner, Charlie Munger. Munger, a brilliant lawyer and investor in his own right, expanded Buffett's thinking. He convinced Warren that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This shifted Berkshire's strategy from buying just cheap cigar-butt companies to acquiring high-quality businesses with durable competitive advantages, or moats. Think of companies like See's Candies, The Washington Post, and of course, Coca-Cola. When Buffett invested $1 billion in Coca-Cola in the late 1980s, people thought he was crazy. The market had just crashed. But Buffett saw a global brand with incredible pricing power in a simple, understandable product. He saw its intrinsic value, and once again, his patience and conviction paid off spectacularly. For the next several decades, Buffett and Munger transformed Berkshire Hathaway from a failing textile mill into a massive holding company, one of the most respected corporations in the world, with stakes in everything from railways and energy to insurance and retail, all from an office in Omaha with a tiny headquarters staff. No fancy computers on his desk, no complex algorithms, just his brain, annual reports, and an unwavering commitment to his core principles. But the story of Warren Buffett isn't just about accumulating wealth. It's about what you do with it. Despite his immense fortune, he lives a famously frugal life in the same house he bought in 1958. He drives a modest car and enjoys a simple breakfast from McDonald's. Why? Because for him, money is not about luxury. It's a scorecard for how well he's playing the game of business. Its real value is its ability to help others. In 2006, he made the single largest charitable donation in history, pledging the vast majority of his fortune to the Bill and Melinda Gates Foundation and other family charities. It was a monumental act of philanthropy, underscoring his belief that his wealth should be returned to society to tackle its biggest problems. So, the untold story of Warren Buffett isn't just a manual on how to get rich. It's a lesson in patience, integrity, and lifelong learning. It's a story about a boy who loved numbers, who found a mentor, who built an empire not by chasing trends, but by staying true to his principles. He shows us that success isn't about being the smartest person in the room, but about having the right temperament and playing the long game. From a paperboy in Omaha to the world's most successful investor, Warren Buffett's journey is a testament to the power of compound interest, both in finance and in life. It's a reminder that the most valuable investments we can make are in ourselves, in our knowledge, and in our character. Thanks so much for watching. If you found this story as inspiring as I do, please hit that like button. Subscribe for more stories like this. And let us know in the comments which part of Buffett's journey resonated with you the most. See you in the next video.